Welcome to the Banking with Life podcast. I'm your host, James Neathery, and I'm here surrounded by my fabulous team, the greatest team in North America when it comes to the infinite banking concept.
Hi, I'm Cindy.
I'm Sue.
I'm Justin.
I'm Megan.
I'm Julie.
I'm Josh.
I'm Melissa.
I'm Jess.
I'm Jake.
Listen, we're thankful for our clients, for you, the listener, for each other, and from all of us to you.
Happy Thanksgiving!
In this episode, Ryan and I talk about what we're thankful for, and we articulate 3 key principles that have developed over the last 149 episodes. Thank you for listening, and happy Thanksgiving. Welcome to the Banking with Life podcast. I'm your host, James Neathery.
And I'm your co-host, Ryan Griggs.
And here we are, deep underground and undisclosed location, downtown Alvarado, Texas. But look, this is a 150th episode of the Banking with Life podcast and the Thanksgiving episode as well.
Yeah, happy Thanksgiving.
Yes. I know I'm thankful. Are you thankful for anything, Mr. Griggs?
I'm extremely thankful. It's been quite a year. Turned 30 this year. A lot of good things have happened since then.
Since you turned 30?
Yeah.
When's your birthday? Y'all can send him a present.
It was in the summer. Let's say that. Yeah.
Well,
no, it's been good. So, I mean, October was 5 years for me in the business.
wow.
So, yeah. Every year better than the last. Knock on wood.
I love that.
Yeah.
October. I mean, I'm still not over the October live event. That was fabulous. It's interesting that was 5 years into you being in the business.
5-year anniversary of being baptized as well.
Is that right? You got baptized the same year?
Same month.
The same month.
And year as when I started working with you.
Wow.
Yeah.
Well, I'm thankful that we have worked together for the last 5 years, and I got to meet you.
Yeah.
And I'm sure your clients are thankful that you got baptized. So they don't have to work with the unbaptized babies out there. I'm kidding. Kind of.
And as David clarified in the recent interview for his role in linking us up.
You know, he took credit for a couple of things there.
Yeah.
So, okay. And I haven't watched the whole thing because it's so long. But I do recall him taking credit for the 6th illustration in equipment financing.
Yeah.
You know, nagging on Nelson.
Yeah, maybe not in a great way, right? Like maybe in like a pestering almost kind of
no
way.
question. Yeah. But I'm glad he did it, you know.
Sure, more illustrations. Why not? I mean, yeah.
Well, I understood from Nelson, and Nelson didn't get into how, but he did get into the why. Because the agents kept saying, oh, you can't do this, you can't do this, you can't do this, because the book was printed in 2000, and that change came, 2011, 2012, I can't remember.
Yeah.
But while he was saying that, I have thought since then, you know, the little key that is on every page of the illustration in equipment financing.
Talking about the breakdown of where the total annual premium outlay is allocated.
Yeah, where it's got the little key up here. Let me get to it. Up in the upper left-hand corner, it shows that the policy is paid up at 165 or age 65, $1.2 million in death benefit. He's 30 years of age. His preferred rating 1499, 25,000 to the PUA.
Mm-hmm.
Yeah. Well, at that time, that key wasn't going to be on each page. It was going to be on its own one little page somewhere behind all the illustrations. Yeah. And I said, no, it needs to be on every page. So I get to take credit for that.
Credit all around.
So since we're taking credit, and of course, everyone knows I'm very thankful that I even got to meet Nelson Nash. If we hadn't met Nelson Nash, if you hadn't met Nelson Nash, we wouldn't be here. We wouldn't.
None of this would be here.
None of this.
Yeah.
Right. You wouldn't be listening. You wouldn't be paying premium. You wouldn't be agent out there, trying to do the right thing with the infinite banking concept if it wasn't for Nelson Nash. So,
yeah,
I'm very appreciative of that.
And 150 episodes. I mean, and like chunky, substantive episodes.
Chunky, yeah. You're the one losing weight. I'm getting fat. Is that why I'm saying chunky?
No,
meaty.
Substantive.
There's very meaty content. And the critique that it's too long. Okay, well, and you pointed out, too, when David was here, that, the number one podcast in the country is long form.
Yeah, in the world. I mean, Joe Rogan, 3-hour marathon style podcast.
Yeah, and JP's coming out with an 18-hour.
Yep. Jordan Peterson's back at it. It's kind of a seminar series on Exodus coming out. That's going to be very cool. People say that in this modern digital age, the attention span is so limited. And I think that's only half true. Our attention spans, let me put it this way, we're more selective with how we spend our attention.
Yeah.
And the result is that certain things that people have determined to be unworthy of attention don't get a lot of it. But then the things that are substantive, or Joe Rogan or Jordan Peterson, whatever the
Bank You a Lot podcast.
that can where people will want to pay attention, that is attractive, then they'll spend it there. Yep. And they'll spend it in droves. And then even more, they'll come out to events like what's happening in comedy right now. You can have these guys do podcasts, and then maybe it's an hour, maybe it's 2 hours, and then they'll sell tickets all over the country. They'll sell out major theaters that before you might have a handful of people 40 years ago would be able to sell out. Now there's several people. There's like this democratization of popularity, right? I mean, there's this growing sense of attraction around certain figures, but more of those figures.
Yeah.
And it's because, the falling price of bandwidth, it's very economical to spend a lot of time to do it in nice image quality with nice audio, to make it accessible to people for free. You have the ability to create anything you want. Yeah.
Right.
Yeah.
I mean,
and we talk to turn on the news. I mean, there's so much negativity out there, but we often jump, and this always happens with the market. We just jump clean over all of the wonderful, remarkable benefits that are constantly accruing because of an ever-expanding market, despite encroachment from the state and other malicious actors. But the plummeting cost of mass communication available on demand, that's going to have an effect. I mean, I think to some degree it already is. I mean, you look how Dan McAdams on the Ron Paul Liberty Report always points out that the public opinion on things, what people think, the ideas they have really matters. Otherwise, the propaganda campaigns wouldn't be so intense. There wouldn't be so much money spent to manipulate public opinion. And so while that can look like awful, horrendous propaganda, and yes, all that is true, it's also an indication of the crucial importance of ideas and what people think. So it's YouTube, a lot of these social media platforms were in their young, sort of adolescent stage in the 2000s, early 2010s. Here we are, early 2020s. I mean, that this stuff is just starting to explode to such a level that, it's widespread. The idea that 20 years ago, you could talk of like a digital public square, which I don't love that analogy at all, but people will use it to describe Twitter or what have you. But the idea that there could be an internet site that was the digital public square, that wouldn't even be a concept, right? And so the fact that that's even part of language is indicative of this transformation, and it's all to the better. It's all to the better.
If it wasn't all to the better, and if the ideas weren't valuable and important and worthy of considering, there wouldn't be the mass deplatforming or limiting of free speech. So the messages are very important. And people, today, people are very intelligent, like our prospective clients, the listeners. In general, I believe people are very intelligent. And they they know what's going on, but the more the pushback on free speech, the broader the recognition is that maybe these things are worth listening to, whatever they are, because there is such a pushback to prevent, the exposure to the masses. So,
and I think in the financial domain, and this is something that I want to talk more, is this, there's been such a secular faith in the tax qualified plan and in the Wall Street products. It's so funny. I mean, people think there's there was, what were the Wall Street sit-ins or whatever it was? There were the Wall Street protests.
Oh, yeah.
You know what I'm talking about. Yeah. I forget the name. Every listener is now reciting it to themselves because they know. But there's this popular antagonism to Wall Street, and that's kind of like accepted. Like, duh, Wall Street, does Wall Street have your best interests at heart? Well, I don't know.
Sure.
But then,
just ask them.
But then how do you plan for your financial future? Oh, well, I got to max out my tax qualified plan.
Exactly.
And I got to buy all these Wall Street products.
Yeah.
It's like,
they're gaslighting themselves.
I know. It's so curious to me that it's paradoxical, even contradicting. I mean, you can't. Similar to, don't want to go into detail, but similar to the pharmaceutical industry. It's
what
everyone, big pharma, all those lawsuits, but hey,
I'm
the
here to get
me.
my sixth booster or whatever. Yeah.
Anyway, but a lot of that's crumbling. I think what the point is, a lot of that's crumbling, and more learning about, getting back to the financial, learning more and more about IBC. A lot of the things, talking about episode 150 and sort of looking back, a lot of the things that maybe we spent more time on or that were more prominent issues early on have sort of, to my mind, or in my experience, kind of subsided. I think, the 1090 thing, the short-term oriented policy design mentality. I think more and more people are understanding that that's what that is. It's a short-term way of juicing cash value in the short run, and that it's not what Nelson taught. And I don't spend much time on it much anymore.
I think, we still hear it.
Knock on wood.
But our clients, they understand. So as you say that people are recognizing that that's not infinite banking, that's not what Nelson did. It's because they have considered and listened to the alternative to that, right? Which is, here, I'm going to call in and, I want to pay X number of dollars in premium. So then they just spit out a page or two of a 1090 illustration. And that gets a lot of traction. Walmart did really well placating to the masses and a cheap price, which, I likened it to that because look, we're all the same. So 1090 is the way to go. And so that serves, me, if I'm the uninformed consumer and I don't know what's going on behind the numbers on that illustration, but I see the massive amount of cash value that I can collateralize immediately, right? Very simple. If you look at a comparative correctly built policy and look at that illustration, and correctly built, and we can go into that, but it's personalized into what the consumer, the prospective client is doing. The first number in the first year of the cash value is higher. But when you look at the whole overall throughout the life of a policy, and it there's a stark difference. And you see the value of long-term capital. And this doesn't mean that you have to have a 60-40 policy or a 40-60 policy. And it doesn't mean that you can't borrow against a policy in the first year. You've got to wait a certain number of years to collateralize the policy. And it also doesn't mean that you're not going to have adequate capital until you're, natural mortality. But the people that are walking over correctly stepping over the 1090 and the other noise out there. It's because there's content, for lack of a better term, there's better information. There's more informative information that's available.
Yeah.
So, but you talk about that you don't, or you deal with that less and less. Mm-hmm. There is still, that's once you get into the infinite banking footprint, right? Even prior to getting into the infinite banking footprint, I still see people have no awareness or an understanding of what they're doing in the financial world, qualified plans, still borrowing money, from third-party lenders, not wanting, to pay interest to a life insurance company. The evil life insurance company is going to keep the cash value when you die, and all of those ignorant things, and they're ignorant, which is not a bad thing. If you're ignorant, you can be educated, right? So you have an opportunity. But I still see the other things that go on in the financial world like that. Oh no, life insurance is still a bad place to put money. Or I'm in a real estate investment group, and their life insurance, you got to cash it out to go get a syndicated deal. I had a conversation with a client this week. An older individual didn't want to pay 5% on a policy loan. So it's like, well, I'm just going to cash out the policy so I can go do this real estate deal, and I expect to get a 12% rate of return or whatever, and a payout.
Current client, prospective client,
current
client.
Yeah, spend an hour after hours with her on the phone and talk her through that and show her how extremely profitable she would be with the life insurance policy, and then the velocity of how many of those deals can you do. And she has had a hard time wrapping her mind around that.
That's too bad.
It's all conventional thinking, conventional finance. So the struggle is real.
Yeah, certainly by no means is the job done. I recall a client, very, very few of the people who get started with me stop, and like a handful or less. But one of them was a young guy. It was great. He was super preferred, big premium relative to his income, smooth. I enjoyed talking with him and working with him. It's great. Something like a month, 2 months later, not long, he got married.
Oh,
yeah.
New opinion enters.
Yeah. The medical student fiance said, "What are you doing?
Yeah.
Get rid of this." I said, "Well, Ryan, I just want to make her happy." Like, okay, you're making the wrong decision, but it's up to you. It's your private asset. You do with it what you want. That's one of the benefits. You can get out if you want out.
And here's the number you can walk away with.
Yeah. But he did. So that still happens. It's not perfect.
It doesn't happen often, but it does happen. And that brings me to another thing that I'm quite thankful for is the noise out there. I talked a little bit about the noise in the client-only event and, internal struggle. Number one, I don't like to listen to myself on these podcasts, right? These episodes. But, do I talk about the noise too much? And I'm not asking for an answer. Internal dialogue that I have, right? And maybe justification, self-justification, and, just considering, Neathery, why do you do that? I like to think I'm well-rounded and balanced, and so I don't want to overly do anything, right? I'm thankful for the noise. They serve a purpose. I go back to Jim Rohn, and, everyone, my father, my dad, everyone can teach you something. Some will teach you what not to do, and others will teach you what to do. And in Jim Rohn, we all serve either as a warning or an example. You can learn from both. And a warning of what not to do and an example of what to do. In the noise, and I know that's very broad, but, the canvas is big, so I'm going to paint with a broad brush. It's prevalent out there that your client, newly married, she comes with her opinions and her knowledge, and her resistance that we all have to knowledge that's counter to what we believe maybe is the truth, right? So it's out there. And so I'm going to continue talking about it. So, but they do serve a purpose, in my opinion, and it's a warning of what not to do. And, I recently found a quote on Facebook, social media, by Adam Smith, and I haven't vetted it, whether it is actually his, but it was attributed to him. Mercy to the guilty is cruelty to the innocent. And I'm like, I love it as soon as I read it. And I'm like, yeah. And I don't know if that's me seeking self-justification, but if it is, I'm okay with it because I believe it, right? Mercy to the noisemakers is damn near violence to the innocent, in my opinion. So I'm going to continue talking about the noise and pointing it out. And there's plenty of it out there. You can go get it. It'll follow you. It'll track you down, right? And get all over you. Just watch on social media too long, and the AI tracks your eyesight and how long you're here and there, and they'll just serve it up to you.
Yeah. I get that with different financial, like those organizations that cater to the advisor. They want you to join their group.
My gosh.
Says my entire Facebook feed is that stuff.
Yeah, they've discovered the infinite banking. Every IMO, independent marketing organization across the country that wants to sell life insurance or whatever their other products are. But when it comes to life insurance, they've discovered how to spell IBC. And they've even discovered, some of them, who created the concept, who had the vision over 40 years ago. And now they are aware of Nelson Nash. And so they'll throw his name out.
Yeah. Hey, Ellen, how about the books?
Oh my gosh.
Everyone's got a book. New way to, things that they discovered.
Yes, always.
Yeah.
Right. But there might be a cursory mention of Nelson in the back or under their breath or somewhere buried into the work that they've done, and it's hard to swag through and slosh through. And
coming from an academic background, and I don't know if I'm just carrying over prejudices. That very well could be the case, but attribution, where I come from, is extremely important. Like putting forth something that you say is original that is not, like allowing for the impression that it's original, like to not be proactive about that to me is like that. It just it's cringy.
That's a death knell in the academic world, isn't it?
Yeah, well, more and more doesn't really count anymore. But it used to be, yeah, that was like the cardinal sin was to copy and paste. The financial industry and just IBC is just, marketing in general has a lot to learn about that.
Don't you even have to cite well in college?
Supposed to, yeah. Back when there were standards in college, yeah.
All right, well, look, while I have this noise up here, I got a couple of comments that I don't know if we're far enough in. I like putting, these types of comments toward the middle of an episode, so only the true listeners will really get to enjoy it. Right? That's my thinking, right? But here's a comment on, and if I go back to, this is episode 150, but there are well over 200 videos on the Banking with Life channel. So this is a shorter video that was recorded several years ago. The infinite banking concept explained in 4 minutes, right? I know it's a little clickbaity, but at the time, the AV...
A little bit.
Yeah. So I'm learning too. This guy, his comment was, is he asking a question or giving information? It's like, can't you learn a lot by asking questions or answering questions? Or is it, am I missing something? Okay. And so who knows if he even had the attention span to listen to the whole 4 minutes? Who knows? I think not, because he makes another comment on same video. Actually, that was The original, was he asking a question or giving information? No, that was, yeah. Okay, let me back up. That guy, I don't know who he is, don't really care. That was a question. Here, another troll comes behind him and makes a comment, says, this is brutal, right? 4 minutes, yeah, smiley guy.
Y'all see me get triggered on the podcast when James says something. The way to trigger James is to leave a comment that might be considered the noise.
Maybe. Maybe. There's other things that trigger me too. But this guy continues. He makes a comment on the same video. Says, I would hope I'd be able to access my own money. This guy didn't explain anything in 4 minutes. He ended every sentence like he was begging his wife to forgive him. I'll explain it a lot faster. It's a scam.
I don't know what that means.
Well, it means that he's got me confused with the men in his family or himself, right? Because they begged their wife for forgiveness at every opportunity, I guess. I don't know. But I'm not even really sure if he's married because he doesn't wear a wedding ring. And neither does his wife. So I don't know. But, at least have a legitimate comment or a legitimate question.
Yeah.
Right? I do not get triggered at legitimate comments and legitimate questions. But I do appreciate the noise.
And a lot of the comments are really good.
Yeah, they really are. I agree.
What I want to, since this is 150, kind of a benchmark or milestone episode, there's been a few things that have come up that we've, just in conversation, that I think have been progressively more crystallized, to my mind, have become more precise and articulate. And I think they're, I don't know, revolutionary might be a big word, but they're, it's a big deal. I mean, there's certain ways of approaching policy design ways of approaching policy design, that certain tendencies, certain dynamics that are good to just keep in mind and that have come out of, in particular, your and my conversation about these things. And a lot of it is just based on stuff that you've said that gets my attention. And then it's like, whoa, don't jump over that. And it's like, that needs to be crystallized and specified. And so I have 3 of them here that I think are pretty important. Number 1 is the idea that anything you do to an underlying base policy introduces some degree of fragility.
Yep. Yes.
So whether it's adding a term rider, regardless of the kind of term, whether it's adding a PUA rider, anything over and above the base policy is going to introduce some idea of fragility. And I know that word fragility is metaphorical, I get it, but fragility from a future tax perspective, right? A lot of this is under the umbrella of conforming with the regulations discriminating between modified endowment contracts and non-modified endowment contracts, MECs and non-MECs. And so when we talk about introducing fragility, we're talking about managing the non-MEC status over the life of the policy. And then embedded within that, implied from that, is what you might have to do unexpectedly in the future, deviating from your original plan in order to preserve that non-MEC status. And so the idea that anything you do there's another idea in here is that there's no way to guarantee against causing a MEC in the future. No matter what, there's stuff that you can do on the margin to minimize the likelihood of it. But and I think that, when we talk about structure and stuff, this is, in a sense, there's some degree to which this kind of statement of anything that you do to an underlying base policy introduces for some degree of fragility. There's some degree which is that, to which we kind of assume that. Maybe it's somewhat obvious, but it would help to go back to it, clearly articulate it, put it forward, because if you start there, that really sheds new light on the question of premium structure. If you go in saying, because the modified endowment contract, I mean, it's terrible, terrible tax status. I get it. But when does it really have teeth? Well, it's got teeth. Like, it's going to hurt more when you've got cash value in excess of the cost basis. When you've got a big old unrealized gain, as they like to talk about it, in the policy. Well, when's that going to be? I don't know. Late in life, decades maybe after you start this whole process. And so, is that when you'd want to have an unexpected tax problem? Like, obviously not. Like, that would be very bad, So I think we jump over a lot of the fundamental framing around premium structure, and this little corollary of the idea that anything you do to an underlying base policy introduces some degree of fragility helps mitigate that.
I'm glad you have 3 points, because there is much more than that. And then let me
don't go ahead of me. I'm going to get to the other ones.
Okay. All right. But not only the tax status of a policy, right? Adding fragility, changing the tax status. But it's an and or, mainly an and, that these structures that I'm speaking to, whenever you add these riders to the policy, and it limits the premium that you can pay. I don't care what that illustration that you're looking at says. When you push print, it's wrong. Dividends are going to go up, dividends are going to go down. And I'm sure you're going to speak to the effect of that. Mm-hmm. It's human behavior as well, right? So who wants to look at a 30-year stream of $100,000 premiums or $10,000 or $5,000? It doesn't matter what the premium size is, but you're looking at an illustration potentially that has decades of high premium. And let me say this, and nobody wants to see that, but typically your basis it doesn't take decades for the cash value to be above your basis.
Yeah.
It years.
Yeah.
Right. Not decades. But the further out you go, the greater the effect of that fragility and the negative consequences. Does that make sense?
The greater the potential impact.
Yeah, absolutely. So it's not just the MEC, but it's also you limit your ability to pay future premium. Now that you may be okay with that if you're 23 years old looking at a $10,000 premium until you're 75 or 80 or 100 or 120 or whatever. Mm-hmm. But you just go talk to your grandfather, your grandmother, your uncle, your aunt, a successful business person, and ask them how much capital do they need or want to have access to in their 40s, 50s, 60s, 70s, and 80s. It does matter, and it will matter. So not only the tax status, but your ability to even formulate capital, i.e. pay a premium.
Well, there's cases where it's because in order to preserve the non-MEC status in the future, one of the things you may have to do with an excessively manipulated structured policy is reduce PUA premium, potentially reverse prior PUA premium with partial surrenders.
That's limited that you can do that. But
exactly, because you're going to, let's flesh that out. Okay, so you get late in life, you've got a wildly manipulated, structured policy, right? Very little to the base, unusual term rider that's, financially engineered to allow the agent to print an illustration that shows as a non-MEC with these exorbitant high premiums with very little to the base. You get way out into the future. There's a fluctuation in the dividend scale. You didn't pay the premium exactly as illustrated at the time of the year that the illustration assumed you paid it. So there were deviations between what was assumed to happen what was assumed to happen was very precisely calibrated, and what you actually ended up doing deviated to some degree. So you get down the road.
Human behavior.
Yeah, you get down the road and come to find out, if you don't reverse prior PUA, or if you don't reduce PUA premium, you may cause the policy to become a MEC. And you're late into the life of the policy when the idea potentially of some form of distribution
passive income through loans, tax-free,
is on the table.
Or even just withdrawal to basis, right?
Right.
Okay.
So you said there's a limit to what you can do to prevent the MEC status late in life in that kind of scenario. And where my mind went is you only have so much basis in the policy. So maybe you can get all the premium back out that you paid in either through partial surrenders or dividend distributions in cash. Okay, well, there's a limit to that.
Yep.
And once you cross over the cost basis, once you start taking distributions in excess, withdrawals or dividend distributions in excess of the cost basis, well, now you're triggering income tax again. So you sort of
withdrawals, yeah.
You limit. There's this narrowing. This narrowing sort of range of possibility.
Yes.
To stay in the lane, to stay within the bounds.
That range narrows. That narrows as time goes on. And then, and so you mentioned the reduced face amount, but a paid up policy. That will not always necessarily avoid a MEC.
Right. Might even cause one.
It could absolutely cause one. And
there's a little
wait,
totally neglected that.
The possibility of that causing a MEC goes through the roof the jankier these policies are built.
Yeah.
Why is that? Reduced base amount, paid up. And it's just a side note. Does your company even pay a dividend on an RPU policy?
Oh, wow.
What financial, do you know? Yeah, your agent doesn't either. I'm just saying. But that affects, and so the face amount reduces, probability of a MEC goes up. The dividends purchase death benefit. Dividends not paid is not buying death benefit. Directly affects the MEC calculations. Does your company even do a secondary or tertiary MEC test on that illustration you're looking at?
Yeah, the companies do a really bad job of explaining, or at least communicating to the client, to the advisor, whether ongoing MEC testing is done in their illustration software. That point that an RPU could cause a MEC in the future. That's, that's not the only thing, right? Dropping a term rider or the expiration of a term rider could also do it, right? The idea of, generally speaking, the idea of a modified endowment contract, too much cash value too soon relative to the death benefit, right? Cash value is getting too close to the death benefit too soon. Why too soon? Well, eventually cash value will equal the death benefit, right? At age 121. So they're approaching, the cash value is approaching the death benefit over time. But if the cash value approaches too quickly in the wise eyes of the U.S. federal government and the IRS, then the policy becomes too excessively investment oriented. It becomes a modified endowment contract, tax status, tax treatment changes. Well, what's one thing that could cause cash value to get too close to the death benefit? Well, it could be a reduction in the death benefit.
What?
Well, what kind of things reduce the death benefit? Well, an RPU, reduced payout, one of the non-forfeiture options, you reduce the death benefit to pay up the policy, that's a reduction in the death benefit. And if the magnitude of the reduction in order to pay up that initial death benefit is substantial enough, then it's perfectly possible. And I've run illustration iterations to flesh this out to show this, then you could cause a MEC that otherwise wouldn't have been caused.
Right.
And
wait, you mean you take the time, Mr. Griggs? Are you telling me you take the time to flesh these things out for your clients?
There's things that you can't do with the software that I wish you could do. Like there are NAIC regulations. Because here's another thing, right? And an increase in the dividend scale, not a decrease, an increase in the dividend scale beyond what's illustrated, that too could cause a MEC.
Yeah.
Because
It's a deviation from the illustration.
It's a deviation. So any deviation, including, and look around what's happening now. Interest rates have gone up for the first time in like 50 years, and maybe they stay sustainably rising. Maybe they don't, but maybe they do. And maybe dividend scale, maybe there's and I've having conversations with the lead product designer at one particular company about this in particular. Yeah. Well, what's that conversation look like? Because that's a new conversation, given the last 40, 50 years of interest rate developments, right? There's this regular downward trend. You know, look at the 10-year Treasury bond over the last 50 years. It's a steadily sloping, steadily declining line. And recently, with what's going on with the Fed and Powell, that's starting to creep upwards. Okay, well, if that sustains, dividend scales track the current interest rate environment, albeit with a lag, but they do track, right? The interest rate environment informs the nature of the yield on investment portfolios. Life insurance companies are investing the premium dollars that they receive in order to generate a steady, long-term oriented return, to be able to pay claims and stand behind guaranteed cash values. And so there's this typically a bond portfolio at a life insurance company that's got a lot of different bonds that have been accumulated over a lot of different time periods. They each have their own yields. And as new bonds are collected in the present day environment, you're going to have corresponding yields to the current interest rate environment. And eventually you do that long enough, the current and recent interest rate environment is going to affect the overall yield on the portfolio, which in turn will affect the surplus, which in turn affects the dividend scale. And dividends go back into the policy in the form of PUA to buy more death benefit and cash value. So there's a train of logic that says that what's going on in the interest rate environment is going to affect the death benefit and cash value growth in an individual policy, every one of which is subject to ongoing MEC testing. So even an increase in the dividend scale could throw off, relative to what was originally illustrated, the cash value and death benefit that's shown in that policy over time. Okay, well, National Association of Insurance Commissioners, in all of their wisdom, right? NAIC is, by the way, just populated by a bunch of state bureaucrats, the people who run the commissions. Yeah, so it's just government officials all the way down. They, in their wisdom, they say, well, we don't want the agent to show, and I understand this, we don't want the agent to show an inflated dividend scale to a client to set. You're speaking to what you would like to be able to do with an illustration. Yeah, I want to be able to show, like, let's assume, and say, look, maybe they restrict, they say, you're not allowed to show this to a client. Okay, fine. I don't even care about that. I mean, I do the illustration out of an abundance of service to show that what we've talked about is aligning with what we're applying for. And the goal is not to set expectations based on an artificially inflated dividend scale. I get that. I mean, we've probably been more critical of inflating dividend. By the way, there are ways for companies to inflate dividends. It's called a dividend multiplier. It's already out there. And the NAIC doesn't get that. Well, that's only one way. There are more ways than that. Oh, how about let's index the dividend? Exactly. I love that. Let's index a dividend to the S&P 500 because, the life insurance company wants to be a financial services company. And then that adds even more. Covering their non-profitability over a given year. I don't know. But that would add even another layer of uncertainty, right? Because all of those dividends are going back into PUA. Okay, so I would like to look at what happens to a given policy, assume the same age of the insured, assume the same total premium outlay, and then look at iterations with different structures under different dividend scale assumptions, including ones in excess of 100% of the current scale, so better than what would ordinarily be better than what would ordinarily be illustrated, and look at those where the dividend scale is lower than would currently be illustrated, to see what happens to the MEC status in the policy over the long. And you can't do that because of these regulations against showing clients inflated dividend scales. So it's, there's anything you do to an underlying base policy introduces some degree of fragility. And so it's like, okay, you want all that cash value day one. Well, at what price? How much uncertainty are you willing to deal with? How much uncertainty from a tax perspective is future you willing to deal with? How solid do you want this to be? How predictable? How in alignment with future expectations do you want this to be? And then in discussing this with another, not this in particular, but a related point with another agent, a brand new agent, it came to my mind that, looking back over the last 5 years, and I don't know if this is totally the case, but if it's not 100% true, it's real close. I don't know that I've had a single client that couldn't have shifted the structure of their policy 10 points more to the base and away from the PUA, and they wouldn't have noticed the difference in the early years.
Exactly.
Because so few people who are really doing IBC, practicing what Nelson taught, are running to the company to get a maximum policy loan day one. Right? I think there's a certain degree to which we overestimate our fear of illiquidity.
Yeah.
There's that, and it's exactly what, Nelson's rules, don't be afraid to capitalize. It's and it's Parkinson's law.
Everybody, in my experience, if not everybody, most everyone, once you start paying a premium, they intuitively recognize that. And then when they listen to legitimate information, in my opinion, that disparages the 1090, right? And if you go into why, and I've shared it with you. I have agents regularly say, James, can we schedule some time, and can you share with me the dangers of a 1090 or these types of policies? They don't know, right? But to the person, when you pay a premium, you get into the second and the third year, they intuitively know, and understand that it's I'm not harmed at all by paying a higher base compared to a lower base. As a matter of fact, it makes more sense to me now that I should pay a higher base. And we have, over the last several years, all the time, people people, thank you too. They contact us all the time, every day. And some are new, most are new to this idea of becoming your own banker. But we get a lot of refugees that you described in the past. It's well, I did this. It doesn't make sense to me. What you're saying does make sense to me. So I want to do that. What you're, want to work with you. Yeah. And their understanding, number one is once you put your hand to the plow and you start putting money in, this fear kind of goes away. And then as you experience a cash value increase on a properly structured policy, for you, and you get more comfortable interacting with the company and with their online portable, your comfort level goes up, period. That the company is doing what you expect it to do. And it's all very easy for a company to pay the dividend that's illustrated in the first year or two, the first 2 or 3 years. They're all very accurate, right? But as your comfort level goes up, and then you actually start applying these principles, and you start actually financing things honestly and legitimately, not trying to make this idea a scheme or just an add-on or bolt-on to whatever it is you're doing. You're actually building capital to become your own banker. And once you start doing that, your confidence goes through the roof. Yeah. But it's intuitive. I'm telling you from experience that, of course, a skinny little base isn't good, but you may not be able to articulate why, right? Or fully understand what's going on behind the numbers, which is exactly what you're diving deep into.
There's a connection to another point here. And I had this conversation with a client recently who got through the whole process, and the particular product we were going to use was a paid up at 95. Yep. And one of the questions he had was, well, why 95? I mean, he's in his early 40s. That sounds like a long time. How about 30 years? Yeah. And I'm like, yeah, why not 30 years? But look, why restrict yourself to that?
How old are they? Were they?
Early 40s.
Okay. So
why not have the ability to pay for longer, right? That's the underlying question of this idea of, is the best kind of policy for IBC a quote unquote limited pay policy, one that will only accept base premium for a short number of years, maybe 10 or 20 years, as opposed to something very long-term oriented. And my point to him was, why not have the ability to pay more for longer should you end up willing and able to do it, because you don't know. And if you're alive, ostensibly there should be income coming from somewhere. And if there is, it might as well go to an asset you own and control. And if that's a good idea now, it's probably a good idea then.
Because taxes are going to go down in the future, right?
Yeah.
So the MEC in the future is not that big a deal because taxes are going to go down, right? Yeah, and you're going to turn 75 and not need any capital. And you may not need it, but maybe you want to give it away.
Yeah, or the need to continually build it, right? So why not have that? And then if you want to shut off the premium because you're suddenly unwilling and unable to make a premium payment, so be it. You know, you have non-forfeiture options that help you do that, but why restrict yourself to that?
Exactly.
Yeah.
Yeah, the future is unknown. There's no question. And you don't know the future. Neither do I. Yeah, the future is unknown. Yeah, okay. Whatever point in time you want to go to in the future, I don't care if you're 55, 65, 75, 85, 95. It doesn't matter. Pick a point in time in the future. It's like your circumstances at that time are going to dictate what you do. And you have no idea what your circumstances are going to be. I mean, we have a general idea of what they would like to be, and we're working today to be in that position, but you don't know. So why not have the ability to pay a premium if you choose to? Right. And then on a properly structured policy, why not have the ability not to pay a premium if you choose to? In either case, it's okay to not MEC.
Yeah.
Right. And then,
so to have a substantial base is what you're saying, like
and the opportunity. So have a correctly structured policy, which is individualized. I mean, we can generalize, there's no question, but you can't overgeneralize to like 1090 and everything's perfect, or 60/40 and everything's perfect. But for the lack of a better word, customized to you and what you're doing right now, what you do know right now, and fully aware of the future being unknown. A properly designed policy, duration is always left out. And that's really what we're talking about, right?
Yeah.
The duration of premium paying ability. So, I mean, that's exactly what I'm talking about, is a proper structure. Put me in a position, because the future is unknown, I want the whole duration. Well, what is that? It's my whole lifetime. If I'm buying a life insurance policy and I have one exponential curve and that policy's on my life, it kind of goes back to what year in the future do you want to sacrifice your policy because of a jank design to get these I call it artificial liquidity in the early years, because it's an illusion. Yes, it's there in the first year, but what does it do in the future? Right. So put me in a position that I can choose. I'm not forced to go through underwriting. I'm not forced to reduce my policy. Mm-hmm. I'm not forced to accept a MEC and then figure out how to work around it, and how to mitigate it. All right. Okay. And I get it. The young man, why not? Why to 95? Why not 10 years? Why not 15, or why not 20 years? Well,
legitimate question.
It is a very legitimate question. And it's also can be followed up by another very legitimate question. Do you have children? No, I know you don't. I do. Might you have children in the future? I don't know. It's unknown. But if you have children, and just taking my case, my youngest child just turned 15. Okay. And we own policies on her, and we're buying more policies on her. And so the most efficient policy that anyone will own is the one that is the oldest, that has been in existence the longest time period. Now, at her age of 15, can I talk about a 55, 65, 70 year timeline?
Sure.
I might not be here. I won't be here. All right. So, but if she's going to be here, God willing, and then my children go on to have children, can't I then appropriately and realistically and legitimately think in 50, 75 year timelines? and like actually be okay with that.
Sure.
As a matter of fact, wouldn't I want to think like if I'm practicing the infinite banking concept, and I am, and we are, my wife is, and very thankful to be able to do that. There's going to be a honking death benefit for somebody at some time. And dang, they don't have a place to put it, or they don't even have a path or a format or an understanding of what to do with it. I mean, how tragic is that? So I get the fact that he may not be able to think in his own life expectancy in terms of 50 years or 55 or to age 120 or whatever, but that's still short-term thinking. Right.
And he just asked the question. I mean, he after I explained him, he understood, but
yeah.
So anything you do to an underlying base policy introduces some degree of fragility. Of course, that doesn't mean don't do anything, right? We had PUA, we had term. I mean, it's just keeping that in mind, right? Managing that potential for mech problems into the future. Okay, but that leads into the second one. And this one kind of came to mind, I don't know, 6 to 8 months ago. Yes, I've referenced it, but you said this and you demonstrated it in your talk at the recent client-only event. But the younger you are, the more as a percentage of the annual premium outlay should go to the base. So just generally speaking, we've established that you want to have a substantial base premium. But on top of that, sort of calibrating one layer further, one layer of resolution higher in that dynamic, in that conversation, the younger you are, the relatively more to the base there should be. And like you said earlier, that everything's personalized. Dividend paying whole life is so flexible. And I think sometimes that's a challenge for people to understand because we're used to such a limited range of choice in what we do financially. But in IBC, there is so much flexibility and possibility, and everything should be customized, but that's not to say that we can't speak in general categorical terms about overall tendencies, right? That one can use to apply to a particular situation where you then go and customize something. And I think this is one example where, the younger you are, the greater you want the base to be, because you have longer to live. And the longer, therefore, the policy has to be in force. And the more so dividends and your behavior will affect cash value and death benefit growth into the long term. I mean, it's related to that earlier point of fragility in the long term when you make manipulations to an underlying base policy. This is in some sense an implication of that. Okay, well, if that's true, and if there's, the further you go into the future, the more uncertain it is, the greater the opportunity there has been for dividends and your behavior to affect what's going on in the policy, the more so you would want a greater component of the contract to be guaranteed, which means a greater base policy, which means a greater base premium as a percentage of the annual outlay from the get-go. And you can apply that all the way back to 14 days after birth.
Yes.
As early as an insurable interest can be established. So that to me is number 2. And I think that would help frame this question of premium structure. It is the exact opposite. It's a dynamic understanding that it contrasts with that constant, unchanging recommendation where a structure everywhere and always is right. Yep. Like that is not true. And in fact, it is the opposite of the truth. What is true is that 1, everything should be customized to the individual. And 2, in fact, there's this underlying current, this sort of range of dynamics to take into consideration that would suggest that, not necessarily dictate, but that would suggest that different people, depending upon where they are in their age, it's relatively more likely the case for that individual that maybe they go with one structure than another. Just that you couldn't have a more polar opposite advisory framework.
No.
And it's kind
of I appreciate you pointing that out. Yeah. It is so true. And let me say on that point, if you think about that, 14 days old, they're a minor child. You can't use term on minor children. That's a true benefit, however unknown to the agent or to the consumer. because you take that component off the table that will add fragility to that policy. Okay. And then going beyond that, you can still put a lot of a lot of PUA on a child's policy, sure, but it's limited because you don't have the term coverage, that higher death benefit. Okay. You can still put a PUA on there. Why would I want to weight it to the base? Right, the old XY scale. And Nelson tells you very clearly, I'll make a couple of points here. You create a base policy premium for the child. It's going to create a MEC number that you can use then to pay the PUA. But the XY scale, the more premium you pay, the shorter the duration that you can pay. So when you wait a 1090 policy, you cannot pay that premium over the whole lifetime and expect no issues and expect that it's not going to be fragile. So on a child's policy, you're still going to be able to pay a PUA, right? But the more PUA you pay, you're going to shorten the duration. Does that make sense?
Yeah, I think the way I would say it is the more heavily weighted the premium allocation is to PUA, the shorter the duration over which that PUA is actually payable.
Yes.
Yeah.
And you're, as a child, you're especially 14 days old, you only want to pay a high premium for 25 years? Really? I mean, and maybe that's the case.
Yeah. Is it?
But,
I mean,
yeah, probably not when you thoroughly think through what you're doing and
what's happening to
can be done. What can be done?
What's happening to income at 25?
Exactly.
Is it going down?
No.
It's like,
and I speak to these young people. And, oh my gosh, I get to speak to the most incredible people, and I'm not patronizing. Okay. These young people are knocking it out of the park, at 25, 35, 45, 55. But you haven't even entered into your peak earning years, young person, at 30. You do not want, that is not the time to limit. That's not the time. And then all of these investments that you're making in crypto, or if your platform doesn't collapse, right? Or whatever. I'm a little shade there, but you don't know the future. The future is unknown, but your need for capital is not going to go down and not go away. Mm-hmm. So why limit yourself? I mean, why? And Nelson tells you very clearly in Becoming Your Own Banker, and I'm not going to tell you where, just read the book and find it. But, and I told you before the talk of October that this slide is the most powerful slide that I'm showing. He tells you very clearly how to build a policy, very clearly. But you have to have a bit of experience to see that.
I think someone would read the book and say, like, yeah, it's not so clear.
Okay. All right. Well,
but I know what you're saying.
I'm saying very directly. Nelson tells you exactly where to start on policy design. And then others you have to intuitively know because of his whole work. But it's all very simple. And it leads me back to the day, early on, Nelson rarely answered a question directly. And oh my gosh, that would make people angry. Just try that on your spouse and see how well it goes. Right? But he would answer questions with questions. He would make you think. And what's the value of that? And so going back to that other troll, the troll earlier is like, is he asking a question? It's like, is there something wrong with questions if they're legitimate?
All right. So that's 1 and 2. Okay. 3. This one's really great. They're all really great. This is essentially the mirror image of Parkinson's law. It's if you're defeating Parkinson's law, this is what it looks like. It's naturally implied. It's just not stated explicitly in the book, right? But
I like that. Naturally implied, but not explicitly stated.
Yeah.
I like that.
That's exactly what it is.
So you might have to read it 3 or 4 times to get it, maybe.
Well, it really helps turn these ideas around in your mind and ask what would the opposite of that look like, and then what are the implications? Yeah, okay. So all right, here it is. The more you make, or the higher your level of income, the greater the percentage of it that should be paid in premium. So the more you make in income, the greater let's say the annual gross income level, let's say, the higher the percentage of it that should be paid to premium. And this is, so it's a nice, so Parkinson's law, work expands to meet the time envelope allowed, applied to finance. Expenses rise to equal income. In America, expenses rise to exceed income. The opposite of that, the more you make, the greater the percentage of it that should go to premium. The larger the margin should be, right? And you may say, well, why is that the case? Well, it's kind of, there's a really wonderful integration with the idea of diminishing marginal returns in economics. The more you make, the less and less of it ought to go to consumption, right? The value of one marginal dollar in terms of the benefit it can bring to you in the form of consumption decreases, right? Now I understand if you make 15 grand a year, to go to 100 is a big deal. And it's not like you're going to consume, less and less as you make 101 and 102,000. I understand that. But generally speaking, assuming you are taking care of your subsistence level needs, right? Your, what I call the need for immediate liquidity, right? Yep. Groceries in the fridge and gas in the car and, oil in the vehicle, all that kind of, your immediate
the heating
needs.
Oil in New York and the New England states,
basic needs. Yeah. Once you've solved for those, once you have sufficient income to handle those kinds of things, and you're starting to save, you've started to beat Parkinson's law, you're consuming less than you're earning. As the income level continues to rise, the amount of it that goes to premium should increase. It's just to say that as you do better, as you earn more, as you become more productive, you should be capitalizing more as a percentage of what you earn. And so it's a natural, what's so nice about that is that it's a natural sort of derived implication of Parkinson's law. And it lays out a track. It lays out the path of expansion in the future. Right? It kind of tells you, generally speaking, what you should be looking to do. There's going to be expansion of the system. There's going to be additional policies so long as this trend towards greater and greater income each year continues onwards. And that's why Nelson had 49, part of why Nelson had 49 policies at the height of his ownership. It's why we each own multiple policies. Your capitalizing behavior, which is to say your premium payment, should increase over time. And gosh, you line that up with the other two corollaries, right? Especially that second one, that the younger you are, the greater there should be to the base. You can imagine this set of policies acquired over time and how they might look given where you were in time, when they were purchased, and what income was like at that time. It's just a nice, there's a nice trajectory embedded in that.
It's very natural as you practice this concept. I mean, and I got a couple of comments on that. That is practicing honest banking.
Mm-hmm.
It is, period. So you're not an honest banker, in my opinion, if you don't do that or you don't move in that direction. And then another comment is like Parkinson's, he shows up every day. I don't care how wealthy you are.
Yeah.
I do not care. And as a matter of fact, the wealthier you become, the problems and the challenges just change. You still have them, right? And you listening, $250,000 in the bank, $500,000 in the bank, $1 million in the bank. As well as I do, that's not the correct place to put it. Right. And the idea, it seems to me, in my experience over the last 31 years, that even wealthy people, quote unquote, are recognizing or beginning to recognize continuing to recognize, more and more people are starting to realize, seeing, being exposed to this idea of the infinite bank concept, and they vet it to the nth degree, just like the individual that makes $15,000 a year. And the harder you look, the deeper you look, the better it looks. So your 3 points are really good, and I appreciate you bringing them out. When you think through that, and it's okay to I'm going to say it all. I don't say it enough, actually. These long form podcasts, episodes, we're having fun. We have a great relationship. We interact very well, but you can listen to these more than one time. And quite often you should. Here's a section that should be listened to more than one time. All right. So Parkinson's shows up daily, and you're talking about the marginal value of dollars. Right? If you're in business and even in your household, if you think about this, look, it might take me X number of dollars to operate, right? And there's a X number of dollars in expense to operate at that level. So marginally above that threshold, the expense is not that much greater. So the value of the profits are therefore greater. Does that make sense? Right.
It's like the Matthew principle: to those who have, more shall be given.
Absolutely. And so,
which is in Nelson's book.
Right. So are you really being a good steward of what you're doing financially? If you've got, I don't want to say lazy money, or if you lessen the requirements of your capital just because you have a lot of it? Right.
It really is. I mean, that Matthew principle integration it manifests so nicely because all of the growth in all of these policies is compounding. So if the total amount of, if the level of premium is increasing as income rises, then there's essentially a compounding effect in your net worth over time.
There's an exponential curve in there.
And the slope increases. Like if you were to, there's an exponential curve inside of the cash value growth of a dividend paying whole life policy. And then imagine there's multiple policies and that the total premium number itself increases.
Yeah.
Right. If you were to look at the aggregate cash value, you add up all of it together, that's an increase. There would be an increasing, just logically speaking, an increasing slope, sort of a compounded effect.
Velocity of the exponential curve.
So long as you're abiding by this, so long as you're abiding by the admonition to, on an ongoing basis, defeat Parkinson's law and capitalize more and more. And there's a sense of, because you hear these stories of, and I really don't like it because it's like, one of the evils of capitalism. You have the rich people with the kids, and the kids are just little hellions, and they're going to squander the wealth of This is the opposite of that. It's like the idea that the trade-off between freedom and responsibility. It's like the more you have, in that Spider-Man quote, with great power comes great responsibility. Like the more you have, the greater the responsibility to steward it well. Yep. And if that, and so the answer to allowing prosperity to turn into profligacy is continued financial discipline. It's to continue to capitalize more and more. And the greater the number, the greater the income, the more pronounced, the more necessary it is to properly steward and to properly capitalize. And the paradoxical, beautiful little implication of that is the more you do that, the greater the capital growth will be. So the more you have, so that scales infinitely.
What?
That's a track. And so because you have this idea that I don't want to leave any money to my kids because, I earned it, I'm going to spend it. It's like, yeah, okay. And you can soapbox that all day long, but it's not, you don't necessarily, there is a path, there is a logically coherent theoretical path that's realistic and practical where you can defy that, Disneyfied, perception, Hollywood perception that there's something inherently rotten about being rich or having a lot of capital. Like, that is not necessarily the case. That is an indication of the breakdown of the financial principles that generated the wealth in the first place. And that's the problem. It's a moral principle problem. It's not a money capital problem. And what IBC does, and what these principles do that we've laid out here today and have laid out in the past episodes leading up to this, is it gives logical coherence. It gives a structure to that scales in a beautiful compounding fashion, all to the benefit of the individual. And it's like, you can do that. There's a path. You can do that. And it's open. One of the points I made in the client only event was that as a financial strategy, there's a sense in which IBC is just more available to all ranges of economic profiles. You know, the W-2 single
$15,000 income earner.
Yeah, to the 1.5 million.
To the
to the 150 million. Yeah.
Doesn't matter.
Yeah. Like, let's have some challenge with these insurance. Let's get a group of them together to share all the risk, Like, it can be done. There's no reason
they do it every day.
There's no reason this can't scale.
None.
Yeah.
And the only reason it can't scale or wouldn't scale is the space between your ears.
Yeah. And, let me say this too. That's good news. Because and that should be exciting to people. Because if you look at, and one thing I wanted to bring up, you look at like what's happening now in the stock market. The Fed's decided that, Jerome Powell is going to be the second coming of Paul Volcker. Hey, great. Correct interest markets. Sure. Let's see how long they last. But
see the ramifications.
And they're called business cycles for a reason. Mm-hmm. They're cyclical. They continue to happen. So you have these people now who are in their late 50s and 60s who have built up this market correlated portfolio in their tax qualified plan or their brokerage account or whatever, and the value of the stocks and the bonds
were hammered this year.
Taken a kick. Worst U.S. Treasury performance, if not in history, for decades. Yeah. And this is the money. This is what people thought was the money that they were going to live on for their late life years. Really freaking sad. I mean, I've got a client right now, and some of them, it's a little distressing to me sometimes because I've just worked, you do what you can in the moment. But if you have someone who comes to you and it's, they're advanced in age. I have one guy recently, and he's got certain circumstances where there is a way out. There's stuff we can do. But you think of the person who's, they've kind of done what Wall Street told them. They had a job, they pursued the benefits, and they had a steady, W-2 kind of income. They contributed to the tax qualified plan. They plowed their savings into market correlated assets, and now they're getting advanced in age. They were told early on, you can retire at 65, and maybe let's round up to 70, and you'll have enough saved in order to live, for that extended lifespan to early to late 90s. And then one of these business cycles comes around, and we've been numbed. It's like this. It's like we've kind of been economically tranquilized since 2008 with profligate monetary policy. So it looks like someone who's new into Wall Street, hadn't been in finance for more than 10 years, thinks recessions don't ever happen, right? Markets just go up forever. And here comes the business cycle. Here comes the results of a change in monetary policy from our commercial and Federal Reserve bankers, giving a nice dose of reality to that stock portfolio.
Yeah, but look,
my point is that's depressing.
No question, but that comes on the heels of these artificially suppressed interest rates. Yep. The lowest interest rate environment in history, recorded history. Yeah. Go through that 10 years in retirement. Oh, wait, I can't earn enough from a CD or a money market, of course not from a money market, or a safe, quote unquote, place to put money. So now I'm forced to seek a higher rate of return.
To yield chase, yeah.
No question. So I'm just saying these corrections are following these low interest rate environments that have suppressed the retirees for a decade, over a decade.
Oh, yeah.
Yeah. And it's like, I want to go back to the yes, you can do this, in light of all the business cycles and all that. It's like, and capitalism is bad and the horrors of capitalism. I mean, let's change the meaning of words, It's what we have today is nothing more than mercantilism, this crony capitalism. It's nothing new, right? And then the taxation, and then the inflation that they're all jumping around Wall Street and the Fed, and it's like a dog and pony show. And it's like, yep, not only can we do this and have a track to run on within the business cycles that are manipulated, within the markets that are manipulated, that's the only way that I'm aware of and have ever experienced that I can shield myself from some of those shenanigans that are very profitable for them, and they're not going to change. So that's another thing that I'm thankful for. Personally, I could care less what the interest rate environment is. Oh, wait, you've been doing all these loans, these HELOCs, these just various lines of credit, and the lowest and then in the lowest interest rate environment ever, and then you get off into premium finance. Nelson had it pretty good. He brought us the infinite banking concept, but now we have these bolt-ons, the HELOC, and all these other opportunities to leverage one of the greatest assets that you can own. What does that look like now? Tell me what a 30-year mortgage is right now. All these young people that were geared up to build or buy a home.
Yeah, and I have talk about trying to buy a home right now. I mean, tell me about it. And I have clients who have done the HELOC thing, and I'm thankful looking back, because one of the questions I raise is with people who have done that is, what does all this look like when interest rates go up?
Oh, I don't want to talk about it because they hadn't gone up for 10 years.
Well, I mean, you raised the question. Look, at the end of the day, people are going to do what they're going to do. And I want them to be aware of things that I think could happen. And it's like, interest rates are going to stay down forever. Okay.
Well, here's some things that, can be considered that I've encouraged my clients. It's like maybe they have a HELOC. Maybe they went out and got a HELOC, and a HELOC is a HELOC. I'm not saying it's good, bad, or indifferent. I'm just saying that be aware that we're in the lowest interest rate environment ever. So while you're knocking it out of the park with that, you better start building capital. I don't care who you are right now. Right. And so if they have, and they did, most of them build capital that's accessible. And now they're at the point where they can get rid of the HELOC or the line of credit or be less dependent upon it. That's where you want to be.
Yeah. Sufficient capital.
Less dependent. That's the solution.
Yeah. To send the banker packing.
That's right. I've said it many times. I mean, my daddy said when I was young, it's like, you got to let the banker be profitable. You got to let the banker be profitable. And he used to go to his banker with his hat in his hand. And then when he was older, before he graduated, the bankers were coming to him with their hats in their hand. What's that word? Where can you find that on an illustration? Yeah. Talking Nelson, you say is a stress-free way of life. Yeah. Yep. And then, you also talked about new, a minute ago, these new people. Ask how many financial gurus you have in your life that have experienced this rising interest rate environment after a pandemic and lockdown of the economies and the supply chain and everything else. These guys in the home office of the life insurance companies haven't experienced this, the majority of them. Yeah, I'm interested to see, and you spoke earlier about how the dividend, will increase, and it will increase as interest rates go up. But you know what else is going to increase between now and then? Is the loan interest rate.
Yeah, I know there's going to be a wave. We should talk about, there's going to be a wave of, as short-term interest rates rise, companies that offer policy loans at variable rates, the loan rate's going to rise. And I can just foresee questions about that. And I just go back to, and maybe this will help preempt a lot of it. This is not about rates.
No.
It's just not about rates. It's about control over the banking function. It's about volume. But it'll happen, and there's going to be more number crunching, and
The loan rates are going to go up. Dividends should go up if they're a well-run mutual company. I think most dividend scales are going to be held this year. And yeah. They follow. They're like a lagging indicator. How's that for Wall Street jargon? But I remember when on the first policies that we purchased, I mean, the dividends were, 6-7%. Oh, wait, and the loan rates were 6.5, 6.35.
I just get so nervous when we talk about credit scales and loan rates. They're not commensurable. They do not. It's percent of what, parts per hundred of what.
Yeah.
And the underlying of what is different.
So this is just another place that you can stop, rewind, and listen, because you're going to get inundated, in my opinion. The promoters that, can spell IBC and may or may not know who Nelson Nash was and what he did. They're going to beat the companies up that have variable loan rates, or they're going to beat the company up that has a lesser or greater dividend. And, and my encouragement would be to look through the noise and discover this idea of becoming your own banker. And where you start is Nelson Nash's books. His first book, Becoming Your Own Banker, and his second book, Building Your Warehouse of Wealth. And then the 6.5-hour digitally accessible video of him giving his presentation. That's where you go. Step right over all of the noise that is, in the IBC footprint, whatever they call it, whatever newfangled book that comes out with a new title and a new discovery of Nelson's work. You could step over. It'll be there after you go to the horse's mouth, go to the source, get a good solid foundation. The noise will still be there, right? And if you wallow around in it long enough, it'll be on you. So that'll help you knock all that noise off of you. Reading the book, Becoming Your Own Banker, Building Your Warehouse of Wealth, and accessing and enjoying that 6.5-hour presentation. And yes, I'm going to throw this out there because I had the question. I haven't listened to that 6.5 hour in a long time, if ever. I mean, I have recordings of Nelson, but I'm told that he references James a couple of times in that video.
It was either here or...
That was downtown Fort Worth, and at a seminar that I was. And I just had a couple of questions recently, and they come up from time to time. James, is that you he's referencing?
Yeah.
And with a big smile, I'm like, yes, it was. Just watch it is my encouragement. Not to hear Nelson say James, to listen to what the man is saying.
Yeah, and if you're my client and you haven't seen that yet, you need to talk to me. I'll just leave it at that.
Well, what are you thankful for, Mr. Griggs? It's Thanksgiving, 150th episode.
Well, I mean, I'm thankful to be a part of this. I'm thankful to have the opportunity to sit across from you and to, help articulate some of these very powerful little kernels of wisdom that I think really should guide the trajectory, guide the theoretical disposition towards policy design. And I think it's going to, there's going to be more to come. I want to do a comparison video. I recently discovered that you can get to all of the legally regulated forms published by insurance companies as part of public information. Yeah. So I'm going to do a comparison of like 10 of the companies that you might hear about in the IBC world, looking not at the illustrations that everybody obsesses over, but at the actual contractual language. And we've made the point that not all PUA writers are created equal, not all term writers are created equal. And what's that mean? Well, I'm going to show you. And that's also led to that 7-part whole life insurance mechanics series that a lot of people have come across. So, I mean, I'm very thankful to be a part of something that, to whatever degree it is changing how people implement IBC. And it's not revising, it's not recapitulating, it's not rebranding infinite banking. It's just a matter of, like I tell clients, calibration and optimization. Like Nelson said, if you know what's going on, you'll know what to do. And one thing that we as agents could do, in my opinion, one thing that I should do is just do a better and better job of explaining more precisely, more clearly why things work the way they do. And if we understand that, then the direction is clear. You know, if you just think in your town, driving around, if you know your town, you know how to get to where you're going. If you go visit somewhere else or you're looking at real estate somewhere else and you don't know the town, you're not going to know how to get to where you're going. I mean, sometimes it's so basic, but like the more you understand the territory, the more familiar you are with the logical framework, with the landscape of possibility in this particular enterprise, the more clear the direction is. And we put ourselves in a position where I don't have to tell you what to do. You don't have to take my word for it. Everybody gets to remain autonomous and independent. And we get to, in a mutually beneficial fashion, pursue a better, more prosperous, dependable future. That's pretty freaking cool. And it doesn't depend on who you vote for or what the Congress is doing or what happened on, the second Tuesday in November or whatever it is. And none of that matters.
Is that when you voted?
and you can spend as much time in the swamp as you want. And then there's a little domain of financial peace and control that once you get through all the setup and learning the fundamentals is really quite simple. Pay a premium. Like you say, the problem is the problem. The premium is the solution. Your need for capital, it's going to go one direction, and you can accumulate more of it in a way that benefits you over the long run. So
I love that. Growing up in a town or living in a town, then you're aware, right, of the direction, how to get from one place to another. And you may not even be aware of the names of the streets that you're on. Just think through that, right? So, I mean, you don't have to be a life insurance expert, right? If I know how to get from here to there,
or how to build the street,
I could care less. And yes, I know we need taxes. Who will build the streets? The same people that build them now. They'll just do it more efficient and cheaper, right? Okay. It's like you don't have to know every single detail, right? You don't have to be a life insurance expert. I mean, just think how many streets you drive on every day that you don't know the name. Now, you're going to be looking at the names of all these streets next week, just like I will be. But you're still going to get to where you want to go very efficiently because you know the landscape.
Oof, come on.
Yeah.
Come on.
It's like, look, I'm thankful for you, the listener. I'm thankful for the trolls, the naysayers. And I don't really, I don't know these guys. I just know that one guy's says he's married, but he doesn't wear a wedding ring. I know. Look, it's like it is what it is, and I'm being reserved.
Yeah.
Okay?
Oh gosh.
But look, I'm thankful for you, the listener. I'm thankful for our policyholders, our clients, policyholders. I'm thankful to be a policyholder, and I'm thankful that you have the opportunity to discover the idea that you can become your own banker. At the you and me level, and it's very powerful. I'm thankful for my wife, my family, our office and team, and most of all, I'm thankful for the creator of this universe and the relationship that I have with him. So, and the opportunity to practice in what is left of a free market that we have. So.
Yeah, and we have the opportunity to do this. I mean, you can become your own banker, and we get caught up in that, in the political or philosophical discussion of, there's never, there's always government and there's taxes and inflation. It's always been a part of the monetary and political scene. It's like, yeah, all of that's true. But there's always things you can do on the margin. We have to act in a particular time and place. And this is available. There is a pathway available. And
yeah.
So.
Okay. What else?
I'm going to go have some barbecue, I think, and
where are you going? Don't throw out any names. You're going local or
explore real estate? Certainly not local in this town.
Man, that's harsh, Mr. Griggs.
They don't watch the podcast, so it's fine. But you live in Texas for long, you can become a barbecue snob, and I'm okay with that. I'm probably there. Yeah.
Okay, barbecue on your way to what? I think I spoke over you.
To look at different potential real estate markets.
Like raw land?
Probably not totally raw. I don't want to supervise a build out on raw land, I don't think.
Crypto's taking a dive, and so has precious metals. Are you going to stop by there at all?
Yeah, and add it to the list of things that I couldn't care less about. That's what I'm up to.
All right.
Happy Thanksgiving.
Yeah,
Enjoy the holidays.
See you next time.
Thank you for joining us on the Banking with Life podcast. If you're watching on YouTube, make sure to like and subscribe and click on that little notification bell. Otherwise, join us on Apple Podcasts and Stitcher for weekly content.